This is what the then Financial Secretary for the Treasury said when Patent Box was introduced a couple of years ago. It's worth reiterating what it's for. It is about encouraging UK companies with IP to retain that IP and develop it here and hopefully take it through to manufacturing and producing products so that it actually leads to something and benefits UK with UK jobs and skills. So it's clearly still very current. And I think the government is still strongly committed to Patent Box. It's an important part of what was set out in the corporation tax roadmap a few years ago under the coalition government as part of developing manufacturing and developing science and technology. I just want to say a bit about how it fits in with R&D relief, because I think that we do expect that most companies that are claiming Patent Box will be in the same kind of space with R&D relief and claiming R&D relief. R&D relief is based on expenditure incurred. So it's an annual claim and it gives a deduction from tax, as you heard earlier. That compensates to a degree for the risk involved in doing R&D. Patent Box, it says there, applies to successful R&D. I'm a little wary about talking about successful R&D because I think that R&D is an activity for itself, but R&D that actually leads to products. And by reducing the amount of tax paid, obviously it increases the reward you get from that. Sometimes heard these described as back-end and front-end tax reliefs, which I think is a bit inelegant, but you kind of get the point. One of them is up front as you spend the money, the other is as the rewards start to come in. I'm not going to say much more about R&D relief today. So, Patent Box, as you've heard, is a reduced rate of corporation tax on income from patents and similar IP. The 10% rate is being phased in, but it'll be fully in place from 2017, and that hasn't changed. Now, come on to this OECD business. We're negotiating at OECD for at least 2 years before I was first involved in this, in order to secure at least a reasonable treatment for IP regimes like the Patent Box. As you'll have heard, that there were countries with some really quite diametrically opposed views on it. I mean, that there was a faction that simply felt reliefs like this weren't appropriate and should be removed. The UK always maintained that our Patent Box was not susceptible to people simply shifting profits around. It does contain safeguards that require the company to have been involved in the R&D and to be actively managing the IP. So we were pushing for a position where basically some such safeguard was considered adequate. But the government was very, very keen to pursue an international consensus and to make sure that rules applied across the board to areas of the world that don't have such strong principles, such strong rules in their tax systems. And so in the end there was a compromise accepted. But it's important, as I say, to underscore the point that the government is committed to Patent Box. There were people who interpreted this as Patent Box has been abolished or Patent Box is being phased out. That's absolutely not the case. We've modified the rules, but Patent Box still sits there. The changes that were made mean that companies will need to know, in formulating a Patent Box claim, how much of the activity that underlies the IP it actually carried out itself or subcontracted to third party as a fraction of the total. That total also brings in acquired IP and subcontracting. So you've heard the good spend, bad spend versus qualifying, non-qualifying dichotomy. It is probably good to avoid terms like good and bad spend. Forceful as they are.
Well, what about just for internal purposes?
Yeah. But the sort of justification for that fraction is that if you were seeking to move IP from one place to another to benefit from a lower tax rate, the ways you might do it are by either acquiring it or perhaps by having it done in one place under contract to someone else so that they'd incur the cost. So that's the justification for putting that in the denominator and reducing the fraction. It's unfortunate that it does leave you in a situation where, in a group company entirely within the UK, where there can be no question at all of profit shifting, you're still regarding that as non-qualifying spend. I mean, that's an unavoidable feature of international tax laws. And it arises partly from the fact that if we were distinguishing between transactions within the UK and transactions between the UK and other countries, that could fall foul of EU law. So we can't make a distinction there. And that obviously applies to all EU countries which have patent boxes. And this was something that was debated within the OECD group when the rules were formulated. But it's a feature of the rules as they are. So if a company is actually doing all of its R&D in-house, or perhaps buying in some specialist services from an unrelated subcontractor, that fraction will come out at 100%, and in practice there'll be very little difference here. The way that the result is calculated changes, but ultimately you get to the same result because the fraction will be 1. That's why it's important that companies are able to associate their R&D with the IP, and that's referred to as tracking and tracing. So companies which are doing that already, or as you heard earlier, which elect into Patent Box within the time limit for claiming under the current rules, which basically means for income which arises before the 1st of July, or for accounting periods before the 1st of July, we'll still be able to carry on. And if they had no new IP arising after that date, they would see no change at all. They would simply be claiming under the current rules for as long as that grandfathering period runs, which is till 2021. So the changes only arise when you look at either companies that elect in later than that, or companies which have new IP arising after the 1st of July. So this is a little bit more about the time limits for electing in. So basically, if accounting period ends before the 1st of July, then that, providing you elect in time, that's squarely in the old patent box. If the accounting period falls across the 1st of July, then that's still in the old patent box as regards the bit before the 1st of July. So it's not a hard date to say you have to elect in by the 1st of July. It's the time limit for that period. In order to elect in, you have to have some patents, but those can be patents which you've applied for but not yet got. So patents pending can get you in. And what happens then is that at the point where they're granted, or at the point where you know you've got them, then you kind of recalculate back, and you can then bring the income into the patent box. But the election has effectively got you in. Just say as a general point, I'm not going to go into complicated numbers or citing sections of legislation or HMRC guidance as far as I can avoid in this. But if you ever do look at our legislation, because all of the patent box rules were inserted into existing legislation, they're all numbered things like 357AB before the legislation goes on to 358, and so it's a bit of a brain teaser, but it's how Parliamentary Council draft legislation where they run out of numbers. So as you've heard, the company must hold qualifying IP, so that is basically a patent or some of those other things arising from certain jurisdictions. And the company or a member of the group must have been involved in developing it. So now those, and also be actively managing the exploitation. So those are the rules I was referring to earlier, which in our view mean that the UK patent box isn't susceptible to people shifting profits around, because you'd probably fall foul of those rules. But that those rules stand. So qualifying IP is in-date patents by approved patent authorities. That is a reference to our published guidance. So CURD stands for the Corporate Intangibles and Research and Development Manual, which is a extremely readable piece of guidance, which is published on the gov.uk website. And if you want to have a look at that, I can point you to the more detailed references. But I think it's probably better to stick with the overview. So. Heard a little bit earlier about qualifying income. So the qualifying income breaks down into a number of headings. So things like royalties from licensing, sales income, and sale of patents. If a company has a patented process to produce non-patented items or uses patented items to provide a service, it can also include profits relating to that. So you derive that income by looking commercially at kind of increasing the margins that brings you. So margins that arise from having the patent, and calculate an appropriate percentage. And that's based on what a third party would pay in terms of royalties to use the qualifying patents. So it's effectively a 10% rate of CT, but it's calculated, it's actually given by calculating an extra deduction. So there's a formula in the legislation which tells you what the deduction is. And it's done in 3 stages. Now, this is about to bring me to a point where, in rewriting the rules, we've had to make quite a big change. And that's one of the reasons why it's important to remember the grandfathering, and to remember that if you are already in Patent Box as it previously existed, and you don't have new IP, then these changes don't affect you. If you do have new IP, because the way the new rules work is quite different, then although the value of your benefit from the old IP shouldn't change, the way the deduction is calculated actually does change. So the 2 ways that there are is that you take the percentage of your income that qualifies as a percentage of your total income, and you kind of project that across to your profits. So effectively you're using your income share from the patents as a proxy for what your profit share would be. So that's in some ways quite a straightforward method. Not necessarily always completely accurate, depending on exactly how the figures are calculated. But it was a default method under the old legislation. The alternative way is that you take your credits and debits arising from the patents, and you distribute your credits and debits between the patents and between everything else. And effectively, you do a kind of mini profits calculation. You take the debits off the credits, and that gives you a profit figure for your patent activity. And, well, you don't need to do one for your non-patent activity, because that's beside the point. And that's referred to as streaming. Now, currently, in the Patent Box legislation, streaming is there as an alternative method that you can use if you want to. It's also required in some circumstances, but generally speaking, the default method was the proportional split that I mentioned earlier. Under the new Patent Box rules, they will only be streaming, and the reason for that is that, as we've said, the OECD rules are all about tying the expenditure on developing the IP to the IP itself and to the income from it. And the way we do that is to create additional streams for different IP items. And that means that streaming is kind of fundamental to it. So if you've got new IP at all, then that's going to be streamed. And we simply weren't able to find a way of combining the 2 methods in one system. So if you only have old IP, yeah, you can continue to do the proportional split. But as soon as you have any new IP, you need to calculate Patent Box for both old and new under streaming. The difference is that for the new IP, for the old IP, you'll just have a fraction of 1 on it because it's not within Nexus. But you still have to apply streaming. Right. So this is stage 2. We have different aspects of the profit from your IP. So the pink part was profit from exploiting the IP. So that's what goes in the Patent Box. That's what the deduction is based on. The yellow is the routine return, which is calculated by taking a 10% margin, which is in legislation, of routine expenses like capital allowances and profit and loss expenses, which don't relate to R&D. And the green bit, that's the marketing and branding, so that's your Heinz ketchup. Okay, so you effectively strip out those things from the profit. the third stage is where Nexus actually bites, which is effectively a further reduction in the profit, but for each stream by applying this. We've called it the R&D fraction. So this qualifying spend over non-qualifying spend, we describe as the R&D fraction in the legislation. Now, I tried to be too geeky here. What you're actually doing is you've got different streams of IP, possibly different patents or possibly different products or something in between. And for each of those, potentially you've got a different fraction if the R&D has been done in different ways. So perhaps for one product you've had to acquire some IP, but for the others you haven't. And strictly I thought you could express this by saying you're multiplying two vectors together. And I did talk to Parliamentary Council about this, but they didn't really think that this would add much to the legislation. So they set it out in words as multiplying corresponding elements of these two things. So what you basically do is you take your profit figure for each stream, you apply the corresponding fraction, and then when you've done that, you add up what's left, and all of that is your total Nexus profit, and which is what is taxed at 10%, and then you calculate the deduction and put that in. So that is wholly within the new patent box rules. If you have old IP, then that doesn't apply at all. Right, and that's how I've set out the fraction. So you can see it's the same as before. Those are the terms as they appear in the legislation. So we have in-house direct R&D expenditure. So that covers things like staff costs, externally provided workers, consumables, payments to clinical trial volunteers, things like that. They're all the same headings that come up in the R&D tax credit legislation and defined in the same way. Similarly with subcontracted expenditure, which may be either to third parties or to related parties, and again that's defined in the same way as for R&D tax credits. The only difference there is that rather than taking 65% of it, which in some parts of R&D tax credits you take the whole amount, and then this 30% uplift. This was basically something which the UK got haggling with Germany. The point of it is that we know, as I said earlier, that applying Nexus in a situation where you've got kind of intra-group transactions going on, the company will get less benefit, even if it's all within country and there's no possible profit shifting going on. So the uplift is to try and compensate to a degree for that. So you can increase the fraction by up to 30%, obviously as long as it doesn't go above 1. It would be nice if it could increase above 1, but it can't. And it's basically, as I say, it's a figure which was arrived at in negotiation, and it loosely reflects the fact that companies may suffer a disbenefit otherwise. Now, the last bullet there is quite key. This fraction is cumulative. So as you're incurring R&D spending or acquisitions or whatever, you're feeding them into the fraction so that it's current, so it's up to date. There's also rules about taking expenditure out of it at some point in the future. I mean, this isn't something which is going to be relevant for kind of 10 or 15 years or something like that. Because obviously, and to jump ahead a little bit and to anticipate what I'm going to say about tracking and tracing, you might be calculating this for a product which includes a basket of IP, and that product over time will evolve. I'm thinking that's possibly less likely to you here. It's maybe more likely where you've got a phone or something like that which has thousands and thousands of patents in it. But it can obviously apply wherever you've got a product. If it relies on multiple IP, then the product will evolve over time and improvements will be made and possibly new IP will come in and old IP will fall out. So there are rules about removing spending from the fraction, and it's basically done on a sort of time basis after 20 years, rather than again trying to do more complicated things about looking at when particular patents come in and out, because the message we got was that was really, really hard to trace. There are some special rules about staged payments and about the situation where you've got income-linked payments, because there's a possibility of a kind of double detriment if you have an income-linked payment that means that when you incur it, you both lose. It reduces your profit directly because it's increasing your costs, and it also weights your fraction against you because you've incurred acquisition costs, and and there are rules to prevent that kind of double hit from taking place. But that's going into the sort of fine detail thing. So let's talk about tracking and tracing a little bit. The OECD's original idea was that as you heard, was that this should be done patent by patent, IP asset by IP asset. And so you needed to attribute spending to each asset and then attribute income to each asset. But they did, and I sort of, I think I take my hat off here to an industry that patiently persuaded them that this was not necessarily achievable in every case. That's putting it mildly. That they agreed in the end to back off a little bit from that and accept that it might not be practical. So, but it is still there as an ideal. So if you actually can do that, if your record keeping and your business and the way you get your income allowed that, so most obviously if you only ever have one patent, I mean that's I guess that's conceivable, but probably in most cases unlikely, then you would still do that. But other methods are also available. So, in essence, and I'm now skipping what's in the legislation but describing how it's intended to work, is that you would be tracking either by an IP asset, if you can, or by a product, essentially a group of IP assets which underlie the same product, or possibly by a product family. So that might be things of the same type, which all have common IP under them. But in each case, the way the legislation is designed is that the company needs to look at what it can reasonably do, and then trace to the lowest level that it can manage. So I think there's a lot of freedom in the way the legislation is drafted, and we did make some changes during the course of the passage of the Finance Act this summer, just to make sure that there was sufficient flexibility, and adjusted what was previously published. It's obviously legislation which is going to have to be tested in practice, and we'll be developing guidance to support it and to explain what in various circumstances you should be doing. But it does mean that there's an exercise to be undertaken based on what the company knows and how it manages its records and what its business is like, which will have to lead through into record keeping, so that even if you're not making profits immediately, at the point you do, you'll have records that will enable you to formulate your claim. So that will mean giving some consideration to this even at an early stage, not necessarily casting anything in stone, but making sure that you actually have those records at a level of granularity that will support your claims in future. So the sorts of records I think which will need to be kept will be records showing the R&D expenditure. So things that will show who you've paid, whether they were connected or not, the acquisition costs. I think those will be very much the same sorts of records that you would have to support an R&D tax relief claim. It's just that, as I say, you may need to have a clear idea of just what potential products they might lead to, not necessarily products that exist at the moment, but how you're expecting to earn income from that. And that includes where you've got blue sky expenditure, which isn't immediately attributable to a product, is being aware of how that's made up, so that in future, if necessary, you can split it. There's something else that is worth mentioning here, which you may hear discussed in the context of this, which is the rebuttable presumption. I haven't gone over it on the slides, but it's worth mentioning, if only because, again, of record keeping. So as a kind of safety valve, there is a provision in the OECD rules that underlie all this, which says that if the fraction is demonstrably wrong, you can effectively challenge it. You can come along and you can say, look, no, this isn't right. This just does not give the right result because of whatever factors, and you can say what the right result should be. Now, there are some conditions on that, but obviously it's expected to be an exceptional thing. It's not something that you'd be doing year in, year out. So the example which is given in the OECD guidance is if you acquire a piece of IP, but you subsequently find it's not actually as useful as you thought it was going to be, and so the value you paid for it doesn't actually reflect its contribution to the product, in which case you might say that you might suggest putting a lower amount in. And there are various other cases, I think, which, again, I think we're going to be exploring in guidance, which might justify this. So it's just worth keeping that in the back of your mind, that if the fraction doesn't give the right result, that there may be a way out. Right. There's one thing which we didn't deal with in the legislation this year, which we are going to be coming to next year, and that's cost-sharing arrangements. It was when all of this was being discussed at OECD, we were conscious that in a cost-sharing arrangement, a company could. I'm trying to think what the right word is. The fraction could come out wrong because, as part of the cost-sharing arrangement, things are being done by different parties. And so we're going to be including some specific provisions on cost-sharing, but those will come in probably in Finance Bill next year. So we're currently working on that, and that will be, at some point, we'll have draft legislation on that, and that'll be made public for comment. But I think our view at the moment is that it's actually less likely to impact most businesses than we thought it was.